Welcome back, everyone. We have some exciting news to get into today. First of all, we had Jerome Powell give another Fed chair meeting, the FOMC meeting, where he basically gives an update on the economy and he decides whether or not we're increasing interest rates. And he held them steady again. So interest rates were held steady. The market liked this meeting a lot. Jerome Powell said basically that the economy is growing while inflation is falling. So it's both good things moving in a positive direction. So we have that going on right now, boosting the market, but then we also have some earnings reports. One of them is PayPal that just released their earnings. If we look at PayPal right now, the stock is reacting by going up a little less than 1%. So investors seem okay with this. They're trying to figure it out. PayPal so far has avoided a huge drop after hours, which is good, but we're also not seeing a big jump up. But we have the official earnings report here, and I'm going to be breaking this down and putting it into context. We're going to see how PayPal's developing over time. Another stock I want to look at is one that's just been trashed. This stock has been obliterated over the past year. In fact, year to date, it's down 58%, and then just today, it's down another 19%. We're talking about Estee Lauder here. This is supposed to be a high quality compounder, a defensive makeup company. It's one that I previously owned and I sold out of it at the start of this year. So we're gonna be looking at Estee Lauder's most recent earnings report this season and how bad things really are. And I wanted to highlight some things that I saw as red flags, some things that I did not like to see in their earnings release. So obviously we have a lot to jump into in this episode, a lot to get to. Now, before I go into it, just one thing I have to mention. If you haven't joined the Patreon to try out Qualtrim.com, I think you're missing out. And if you want to give it a try without giving any money, you don't have to pay anything up front, you can join today and get a month-long free trial. You get all of November to try this out without risking anything. So join today, try it out. I think you'll love it. We have a growing amount of users. In fact, right now we have over 5,000 users. It grows by hundreds every single month, because it's a lot cheaper than the alternatives. It's $10 a month. So you get a month-long free trial to try this out. After that, it's $10 a month, cancel anytime. There's literally no risk. And you also gain access to the Joseph Carlson Show Discord community. We have thousands of active investors on that. We're discussing investing all the time. And you gain access to exclusive episodes. I have one coming up, which is a more in-depth look at Netflix, my future for that stock. So try that out. Again, there's a link in the description below. Now let's go ahead and jump right in. We'll start off with PayPal. If we go to the earnings release here, we can see what happened over the past quarter. The net revenues increased by 9% year over year. So 9% net revenue increase. That's a little bit of a beat, a slight beat on that. The earnings per share are up 20%. That is, again, a slight beat. So they beat on the top and bottom line. The stock doesn't seem like it's reacting too well right now. It's up a little bit, but it's a green day and it's only up 1%. So it seems so far this is a marginal beat, mostly in line with expectations. Let's go ahead and continue reading. Now they gave out 4 key metrics here. Their total payment volume grew by 13%. Net revenues grew by 9%. So that looks good. Payment volume, net revenues, operating income up by 8%. And then the earnings per share up 20%. All of that looks positive. Everything moving in a right direction here. They say that they had a strong third quarter. And they're rehashing some of the same metrics here. What I really want to look at with PayPal is the cash flows of the company, because this has been the weak spot of PayPal. If we go to Qualtrim, I want to illustrate what I'm talking about here. Let's bring up the free cash flow. Let's zoom in on the past, let's say 5 years here. This is the past 5 years quarterly of PayPal's free cash flow. Do you notice the trend here? The trend is that overall, it's completely flat. Now, not every company has to grow free cash flow every single quarter. Some companies just have, generally speaking, flattish free cash flow. Those companies are typically not great investments because they're already priced in, they don't have much growth, there's not really a lot of room for outperformance. Now, Qualtrim doesn't have the latest numbers that were just reported 20 minutes ago. It's going to take a day for that to get inputted. But this quarter right here also was a one-time issue. And if you took that out, the free cash flow was even around there during the last quarter. So far, this is what I've seen, a constant trend of flat free cash flow, not a positive sign for the company. And I think that they're also facing a lot of challenges that I'll get into later. But let's first go and see what the latest quarter looks like with this metric. Now, right here, they talk about the cash flow. The top line, they say they generated around $1.3 billion in cash from operations, free cash flow of $1.1 billion, which would put that right where it's always been. Now, if we keep reading, they reveal something here very important. The cash flow from operations and the free cash flow include a $0.8 billion negative impact from buy now, pay later. Excluding the impact of buy now, pay later loans origination, the adjusted free cash flow is $1.9 billion in Q3 of 2023. On Qualtrim, when this is updated, it's going to reflect $1.1 billion. So the orange bar will be right there. But they're saying in this release that they have something impacting their free cash flow to the extent of $0.8 billion. So if you normalize that out, really their free cash flow is $1.9 billion. So if you give them the benefit of the doubt and you say, look, they have this impact from this buy now, pay later. Outside of that, this is what they would have generated. This looks a lot better. That is way above their historical trend. I like seeing that. I like seeing the free cash flow growing. So this quarter does look a lot better if you want to factor in the buy now, pay later, which I think investors should. That should be a consideration. So I think so far the report looks really good. They have some metrics growing. Their free cash flow looks like it's above expectations. Now we turn to the guidance. This is where I think they have a little bit of a weaker spot in the report. Net revenue growth of 6 to 7%. That's really not that strong of growth. For a company like PayPal, growing 7%, most companies in my portfolio are growing faster than that. So that's a slower grower of a company. Now we move on to the full year guidance for 2023. This year, they're expecting to have a full earnings per share of $3.75 compared to $2.09 for the prior year, which seems like a massive jump. Again, when you look at this stuff without full context, it can paint a very different picture because we're going from $2 to $3.75. Seems like this is a massive improvement, that this company's compounding very quickly. But again, if we use Qualtrim, we can get better context of what this looks like over a longer time horizon. Here are the earnings per share diluted every single year for PayPal up until 2022. In 2022, like they say, it was $2.09. And they're expecting again $3.75. So again, it looks like a massive improvement. $3.75 right up here. In reality, that is a massive improvement from 2022, but it's not too big of an improvement from 2020 or 2021. It's mostly flattish, it's slightly above, still a very positive development, but given the context, they're kind of trying to catch up to where they were just a couple years ago. Overall, I really don't think this is too bad. It's hard to find a big weakness here. I'm surprised that PayPal isn't trading higher. This stock really can't catch a break. It's up 1% after hours, so investors don't seem overly impressed by this, but I think it looks pretty good. The earnings are growing, the free cash flow is growing, the revenue's growing a little bit slower than I would like, and right now the valuation does look attractive. Even with stock-based comp, it looks decent. It looks like an undervalued company. The PE ratio also looks very low, a 15 forward PE. So investors don't seem to be pricing in a huge expectation with this stock. So overall, I thought PayPal's report was fine. I think it was passable. In fact, I didn't see any red flags or anything to be really concerned about. I think investors in PayPal will look at this as a mostly positive report. It seems like it's moving in the right direction. Now, moving on, we look at another company that's going through a very difficult time, which is Estee Lauder. This is a company that was looked at as one of the high-quality compounders. It's one that I've previously owned, and it's down 58% year to date. Over half of its value gone. It's down 19% just today. Now, I first want to just look at my portfolio and my history with this company. At one point, I had Estee Lauder in my consumer category. It was one of the many that I had here along with like Disney and Home Depot, and I sold out of all of those companies. The reason that I sold out of those companies and I instead stayed invested in a company like Costco is again because of that predictability factor. I've been positioning my portfolio into companies that I think are highly predictable. So if I get any sense that they're becoming less predictable, that the future is murky and uncertain, I sell out of those companies and buy ones that I think are still highly predictable. In this case, I think Costco is still very highly predictable, so I'm keeping the company. So Estee Lauder was one of these companies that I sold early, avoiding a 50% drawdown on the stock. And I want to go over some of the things I saw in the company that were red flags to me and why I saw this one as becoming more unpredictable. First of all, the financial report just looks terrible. All the numbers are moving in the wrong direction. Decreases in earnings per share, decreases in revenue, decreases across every part of their business segment. But overall, when I read the report and I listened to the earnings call, one of the things I see them do is they play the blame game. They make excuses. They don't blame the right thing to blame for their underperformance. Now let's go ahead and take a look at their earnings release here, and I'll show you an example of what I mean. This right here is an example of them blaming the Middle East conflict, especially Israel, for part of their underperformance here. They say, second, we're reflecting the business disruption in Israel and other parts of the Middle East for fiscal year 2024. Our revised outlook continues to expect sequentially improving sales trends and yada yada, but they blame Israel in this release. Now let's go ahead and take a look at another example here. This reduction also reflects the risks and potential business disruptions in Israel and other parts of the Middle East, as well as the currency headwinds. So they again mention Israel twice, not just twice, but 4 different times in this earnings call transcript. When in reality, when we look at this, even though it's tragic what's going on in the Middle East with Israel, it's a small portion of their overall business. The market includes India, the Middle East, Turkey, South Africa, Central Europe, Israel, Russia, Kazakhstan, Thailand, Malaysia, Vietnam, Indonesia, Philippines, Singapore, Brazil, Mexico, Chile, Colombia, Panama, Peru, Argentina. But yet they highlight and focus on one country repeatedly in their earnings report. In reality, that's not the problem with Estee Lauder. That's not the reason the company's struggling. The real thing to blame for their underperformance is quite obvious. They're not executing well on their brands. They're being beaten out by competitors like e.l.f., offering a cheaper product which is also being marketed incredibly well. I get the sense that most investors in Estee Lauder are no longer buying their excuses, and they're seeing this company far underperform their competitors. L'Oreal, e.l.f., name off a different company that's in the beauty category, this company's doing much worse. So instead of blaming international conflicts, they need to look at their execution and their strategy, compare it to competitors, and I think you'll find more weaknesses there. As far as I'm concerned, it's too risky for me, too unpredictable. I think that outlook is too murky. I'm glad I exited when I did, and it's not a company I'll be jumping back into. Now, if you want to see companies that I do own or ones that I am buying, make sure you subscribe to the channel because I have a portfolio update on the Story Fund coming out this week. That's all for now. See you in the next one.